Sell it, IRS gets a cut. Refinance it, IRS gets nothing. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no tax using my zero tax blueprint. You've got $200,000 of equity sitting in a rental property. You've got two choices: sell it or refinance it. One of those choices hands the IRS a check. The other one doesn't hand them a dime. Today, I'm breaking down exactly why and why the investors who understand this difference are the ones building wealth faster than everyone else. Here is the entire concept in one sentence. Debt is not income under Internal Revenue Code, Section 61. When you sell a property, you're disposing of an asset. That triggers a potential taxable event. The IRS requires you to calculate the gain on that sale and report that. But when you refinance, you haven't disposed of anything. You still own the property. You just borrowed against it. And borrowed money has never been and will never be taxable income, no matter how large the loan is and no matter how or what you do with the cash. Pull $50,000 out, pull $500,000 out. Doesn't matter. It's debt. Debt gets repaid, not taxed. It's the same principle that applies to any loan: personal loan, a car loan, a business line of credit. Borrowed money is never income because you owe it back. And that's exactly why savvy investors treat refinancing as their primary tool for accessing equity without ever triggering a tax bill. Now compare that to selling. The moment you sell, three things hit you at once. First, depreciation recapture under Section 1250. Every dollar you deducted in depreciation over the years gets recaptured and taxed at up to 25%. You got the deduction, and now you're paying it back. Second, long-term capital gains. Whatever appreciation you've built gets taxed at 0, 15, or 20%, depending on your bracket. Third, the net investment income tax. If you're over the threshold, $250,000 for married filing jointly, or $200,000 for single, add another 3.8% on top of the gain. Stack those together, and a seven-figure sale can easily hand 25 to 30% of the gain straight to the IRS. That's money that's gone. It's not deferred. It's not recoverable. It's just gone. This is where refinancing becomes a wealth-building engine instead of just a tax avoidance trick. If you're running the BRRRR strategy, buy, rehab, rent, refinance, repeat, the refinance step is the whole point. You force appreciation through the rehab, you refinance at the new higher value, you pull your own original capital back out tax-free, and you redeploy it into the next deal. You never recognize a dime of gain. You still own the asset, it's still cash flowing, and your original capital is now buying you a second property. This is how investors describe getting an infinite return, because their invested capital gets returned to them without a taxable event, while the asset keeps working for them. Here's the part almost nobody talks about, and it's where people get themselves in trouble. Just because the refi proceeds aren't taxable doesn't mean the interest on that new debt is automatically deductible. Under the interest tracing rules in temporary regulation 1.163-8T, deductibility depends on what you actually do with the money, not what property secures the loan. Pull equity out of a rental and use it to buy another investment property, that's interest traces to the new investment and is deductible against that activity. Pull equity out and use it to pay off personal credit cards, buy a boat, or fund a vacation. That interest is now personal interest, and personal interest is not deductible, period. So the tax-free part is guaranteed. The deduction on the new interest expense is not. That depends entirely on tracing the use of the funds. Keep the paper trail. Document where the money went. If you're mixing investment and personal use, this is where a bookkeeping mistake turns into a loss deduction. Refinancing isn't automatically the better move forever. There's a trade-off, and it's important to be honest about that. If you hold the property until death instead of selling, your heirs get a full step-up in basis under Section 1014. All that deferred gain, the depreciation recapture, the appreciation, everything disappears. It's never taxed to anyone. That's the ultimate payoff of don't sell, refinance instead. You're not just deferring the tax, you're potentially eliminating it entirely if you hold long enough. But refinancing means carrying debt indefinitely, and debt means risk. Higher leverage, higher monthly payments, more exposure if rents dip or rates move against you at your next refinance. Selling gives you certainty and liquidity today at the cost of a tax bill today. Refinancing gives you liquidity today with no tax bill at the cost of ongoing leverage risk. The right call depends on your risk tolerance, your hold period timeline, and whether step up in basis is actually part of your long-term plan. So the short version, selling realizes your gain and hands a chunk of it to the IRS. Refinancing lets you access that exact same equity, keep the asset, keep the tax deferral, and keep the door open to full step up at death. That's why the wealthiest real estate investors almost never sell. They refinance, they reinvest, and they let time and leverage do the rest. If this helped you see your equity differently, subscribe. I break down strategies like this every week to help real estate investors keep more of what they build. And if selling is still the right move for you, that doesn't mean you're stuck with the full tax bill. The right planning can reduce or even eliminate what you owe. Check out my videos on installment sales and 1031 exchanges and the lazy 1031 to see exactly how.